Okay, hello guys. We are from Group 3. We'll present the material of Chapter 13, which is current liabilities, provisions, and contingencies. So, before we start presenting, let us introduce ourselves. Start from me. My name is Abi Suryo, with the last three-digit name is 136.
Hello guys, my name is Kalila Zaina Putri, and my last three-digit name is 181.
Okay, my name is Qonita Rahmania and my last three-digit name is 096.
Okay, my name is Nakeisya Aurelia and my last three digit of name is 255.
My name is Regina and my last three-digit name is 269.
And last, my name is Iffah Yusriliyani with name 069.
Okay, let's start from the material one will be presented by Qonita.
Okay, today we're gonna present about current liabilities, provisions, and contingencies. By the end of these sessions, we should be able to describe how current liabilities are recognized, valued, and reported, explain the accounting treatment for various types of provisions, understand the reporting of loss and gain contingencies, and then present and analyze liability related information effectively. There are three essential characteristics about current liabilities. The first one is present obligations, the second is arises from past events, and the last one is results in an outflow of resources, which is cash, goods, and services. So, uh, to start, we're gonna start with question: what exactly are current liabilities? A current liabilities is one that is expected to be settled within the company's normal operating cycle or within 12 months after the reporting date. A current liability is reported if one of two conditions exists. The first one is liability is expected to be settled within its normal operating cycle, or liability is expected to be settled within 12 months after the reporting date. The operating cycles is the period of time elapsing between the acquisitions of goods and services and the final cash realizations. And remember, the operating cycle refers to the time between purchasing inventory and collecting cash from sales. If the liability falls within this cycle or within a year, it's current. And next slide. So yes, there are many types of current liabilities. Some of them is accounts payable, notes payable, current maturities of long-term debt, short-term obligations expected to be refinanced, dividends payable, customer advances and deposits, unearned revenues, sales and value-added taxes payable, income taxes payable, and last is employee-related liabilities. These are obligations that demand attention because they reflect what the company owes in the short term. Next slide. Okay, and then let's break this down further, starting with accounts payable. Accounts payable are balances owed to the others for goods, supplies, or services purchased on open account. There are amounts owed to suppliers for goods or services received on credit. Typically, payment terms range from 30 to 60 days, and then a term like 2 per 10 net 30 means the buyer can get a 2% discount if they pay within 10 days, otherwise, the full amount is due in 30 days. Next slide. Okay, the next is notes payable. Notes payable written promises to pay a certain sum of money on a specified future date. The characteristics of notes payable are arise from purchases, financing, or other transactions, notes classified as short-term or long-term, and less is notes may be interest-bearing or zero interest-bearing. The notes payable can be credited for financing or purchasing purposes and may be classified as either short-term or long-term. And they may bear interest, which must be recorded over the life of the note, or be zero interest bearing, where the interest is in the repayment amount. Next slide. Okay, the next is interest bearing note issues. As illustrations, let's look at a practical example. Castle Bank agrees to lend 100 oh, 100,000 euro on March 1, 2029 to Landscape Co. If Landscape signs a 100,000 euro 6% formal note, Landscape records the cash received on March 1 as follows. The journal is cash 1,100 euro on notes payable 100,000 euro. And then, on the loan date, they debit cash and credit notes payable. At the end of the period, they must recognize the accrued interest before paying the total upon maturity. And the total is 102,000 euros. Next slide. Yes, here are the calculations. If Landscape prepares financial statements semi-annually, it makes the following adjusting entry to recognize interest expense and interest payable at June 30, 2019. Interest calculations is 100,000 euros times 6% times 4 per 12. It equals 2,000. And the journal is interest expense 2,000 euros on interest payable 2,000 euros. Next slide. And at maturity on July 1, 2020, Landscape records payment of the note and accrued interest as follows. Notes payable 100,000 euros and interest payable 2,000 euros on cash 102,000 euros.
On 1 March, Landscape issues a $100,000 for a month, zero interest bearing note to Castle Bank. The present value of the note is $100,000. Landscape records this transaction as follows. A zero interest bearing note is a loan document that looks like it has no interest, but actually the interest is hidden. For example, here the company Landscape gives a note payable to Castle Company that says Castle Company must pay back $102,000 euro with 100% interest in 4 months. Next, Nakisha. Next. Eh, back. Yes, yes. In the journal entry, Landscape only received a 100,000 euro. Why is that? At the time of the initial journal entry, the company records the amount of cash it actually received. So Landscape debited cash 100,000 euro and credited notes payable 100,000 euro when receiving the loan. The missing 2,000 euro will be recorded later using the accrual basis. Next. 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 Stop. Okay. Interest expense of €2,000 is debited. The notes payable of €2,000 is credited. Then on July 1, Castle Bank simply pays the full amount of the debt. Next, Nakasha. 1 September, purchased inventory from Orion Company on account for $50,000. $50,000. Derby records purchases, gross, and use a periodic inventory system. On 1 October, issued a $50,000 12-month 8% note on Orion in payment of account. On 1 October, borrowed $75,000 from Shore Bank by signing a 12-month zero interest bearing 8100,000 note. 81. Sorry, ulang yang ini. On 1 September, purchase inventory from Orion Company on account for $50,000. Derby records purchases, gross, and uses a periodic inventory system. On 1 October, issued a $50,000 12-month 8% note to Orion in payment of account. On October 1, borrowed $7,500,000 from the Shore Bank by signing a 12-month zero interest bearing $8,100,000 note. Next, Nakisha. Next. Yes, stop. Derby purchased inventory worth $50,000 from Orion on credit. Next. Um, Next. Oh, stop. Derby converted the $50,000 debt to Orion into a note payable with 8% interest, but the 8% interest will be paid later, all at once at maturity. So, bunga per tahunnya $50.000 dikalikan 8% menjadi $4.000. Per bulan $4.000 ditambahkan 12 bulan menjadi $333. Pada tanggal 21 mencatat beban bunga Derby setelah 3 bulan. $3.003 dikalikan 3 bulan menjadi $1.000. Next, Kesha. Similar to the Landscape and Castle Bank case earlier, Derby uses a zero interest bearing note. Borrow $75,000 from the Shore Bank by signing a 12-month zero interest bearing $81,000 note. Jadi pada tanggal 31 Desember mencatat beban bunga $6.000 dikalikan 3 per 12 bulan menjadi $1.500. Jadi saat jatuh tempo nanti Derby harus membayar $81.000. Next. Current maturities of long-term debt refer to the part of long-term debt like bonds or loans that will be due within the next year. Since they are due soon, they are classified as current liabilities. However, debts are not included in current liabilities if there are specific assets set aside to repay them, and those assets are not current assets. Second, they will be repaid using the proceeds from a new long-term debt. Third, they will be converted into common stock. So only debts that will be paid with current assets within the next year are recorded as current liabilities.
Okay, the next is short-term obligation expected to be refinanced. Exclude from current liabilities if both of the following conditions are met. First, must intend to refinance the obligation on a long-term basis. Second, must have an unconditional right to defer settlement of the liability for at least 12 months after the reporting date. Okay, the CFO for a young corporation is discussing with the company's chief executive officer issues related to the company's short-term obligations. Presently, both the current ratio and the asset test ratio for the company are quite low, and the chief executive officer is wondering if any of these short-term obligations could be reclassified as long-term. The financial reporting date is December 31, 2018. Two short-term obligations were discussed and the following action was taken by the CFO. Young has a $50,000 short-term obligation due on March 1, 2019. The CFO discussed with its lender whether the payment could be extended to March 1, 2021, provided Young agrees to provide additional collateral. An agreement is reached on February 1, 2019 to change the loan terms to extend the obligation's maturity to March 1, 2021. Financial statements are authorized for issuance on April 1, 2019. Since the agreement was not in place as of the reporting date, which is December 31, 2019, the obligation should be reported as a current liability. Young also has another short-term obligation of $120,000 due on February 15, 2019. In its discussion with the lender agrees to extend the maturity date to February 1, 2020. The agreement is signed on December 18, 2018. The financial statements are authorized for issuance on March 31, 2019. Since the agreement was in place as of the reporting date, December 31, 2018, the obligation is reported as a non-current liability. So next is dividend payable. Amount out by a corporation to its stockholders as a result of board of directions authorization is generally paid within 3 months. Undeclared dividends on cumulative preference shares are not recognized as a liability. Dividends payable in the form of additional shares are not recognized as a liability. So it's reported in equity.
Next is current liabilities for customer advances and deposit. Jadi, returnable cash deposit is money borrowed from customer of employees as collateral for loaned goods or equipment, and then as collateral for contractual obligations. This deposit can be classified as current or non-current liabilities. It is considered a current liability if the deposit is expected to be returned in less than 12 months or 1 year, and it is considered a non-current liability if it is returned in more than 12 months. Next slide. Next is for unearned revenue. Unearned revenue atau pendapatan diterima di muka dianggap sebagai current liabilities. For the example, type of business is airline. Untuk tiket pesawat dibeli hari ini untuk penerbangan minggu depan, maka uang yang diterima sekarang dicatat sebagai unearned passenger ticket revenue. Setelah penerbangan dilakukan, barulah dicatat sebagai passenger revenue. Hal itu juga terjadi pada contoh yang lainnya. Next slide. Untuk contoh soalnya, yang pertama, ada Sport Pro Magazine sold 12,000 annual subscriptions on August 1st, 2019 for $18 each. Prepare Sport Pro's August 1st, 2019 journal entry and annual adjusting entry. Untuk pencatatan pada tanggal 1 Agustus, maka dihitung terlebih dahulu 12.000 dikali 18.000 adalah 216.000. Maka untuk pencatatannya, cash pada unearned revenue sebesar 216.000. Kemudian untuk adjusting entry-nya, karena langganan telah berjalan selama 5 bulan, dihitung dari August to Desember, maka kita hitung unearned revenue-nya dianggap sebagai revenue dengan cara menghitung 216.000 tadi kita kali dengan 5, kemudian dibagi 12 karena untuk satu periode. Hasilnya adalah 90.000, maka untuk pencatatannya unearned revenue pada subscription revenue. Next slide. Next, ada current liabilities yang berasal dari sales and value add taxes payable atau utang pajak penjualan dan PPN. Untuk bedanya sales tax dan VAT ini adalah kapan dikenakannya. Kalau sales tax dikenakan hanya pada konsumen akhir saja, tapi untuk VAT atau value add taxes ini dikenakan di semua tahap produksi atau distribusi. The next slide. For the example, Hello Supermarket sells loaves of bread to consumer on a given day for $2,400, assuming a sales tax rate of 10%. Hello Supermarket makes the following entry to record the sale. Untuk pencatatannya, maka dihitung terlebih dahulu 2.400 kita kali dengan 10%, hasilnya 240, maka pencatatannya cash di debit sebesar 2.640 dan kreditnya ada sales revenue 2.400 dan sales tax payable 240 di kredit. Next. Nah, seperti yang sudah dijelaskan sebelumnya bahwa VAT atau PPN ini dipungut setiap kali sebuah bisnis membeli produk dari bisnis lain. Kemudian untuk contohnya ada Hill Farm, wheat company grows wheat and sells it to Sunshine Baking for 1,000. Hill Farms wheat makes the following entry to record the sale, assuming the VAT is 10%. Seperti cara menghitung yang sebelumnya, bahwa 1.000 dikali 10%, maka untuk pencatatannya cash di debit sebesar 1.100, sales revenue di kredit 1.000, dan VAT di kredit sebesar 100. Next slide. Contoh selanjutnya ada Sunshine Baking makes loaves of bread from this wheat and sells it to Hello Supermarket for 2,000. Sunshine Baking makes the following entry to record the sale, assuming the VAT is 10%. Cara menghitungnya berarti 2.000 kita kali dengan 10%. Maka untuk pencatatannya debit sebesar 2.200 cash, kemudian kredit sales revenue 2.000 dan VAT-nya kredit 200. Sunshine Baking kemudian menyetorkan 100 euro kepada pemerintah, bukan 200 euro. Alasannya karena Sunshine Baking telah membayar 100 euro kepada Hill Farms Wheat. Jadi yang disetor hanya selisihnya, yaitu 100 euro. Next slide. Okay, and in the third example, we see how accounting for VAT is done. Hello Supermarket sold bread for 2,040 to a customer, and since VAT is 10%, they receive a total of money is 2,640 in the journal. 2,400 euro is recorded as sale revenue and 240 euro as VAT tax liability. However, since Hello Supermarket had previously paid VAT of 200 euro when purchasing from the supplier, they only need to remit the difference, which is 40 euro to the tax authority. Next slide. Okay, let's begin with income tax payable. Every business is required to prepare an income tax return and calculate how much tax is owed to the government. This unpaid tax of the reporting date is classified as a current liability because it will generally be settled with the next 12 months. Companies must make periodic tax payment, typically monthly or quarterly, depending on the tax laws. It's also important to note that there can be differences between taxable income and accounting income due to differences in revenue and expense recognition. We will discuss the timing and permanent differences in more detail in chapter 19. Next slide. And then we move on the employee related liability. There are amounts out to employees for salary, wages, or benefits, and they are commonly reported as current liabilities in the balance sheet. They include first payroll deductions is tax and other amount withheld from employee paychecks, and second is compensate absence is paid time of like vacation and sick leave. Bonuses is are amounts promised but not yet paid. The next slide. Okay, in employee related liabilities is ada payroll deductions. One major type of employee-related liability is payroll deduction. These are amounts withheld from employee wage that the employer must remit to third parties. They typically include first income tax withholding, employee portion of social security tax, and union dues. The employer is responsible for collecting and holding these amounts and must report them as liabilities until they are actually paid to the appropriate authority. Next slide. Okay, now let's look at an accounting example. As sum, an employee weekly payroll is $10,000. From that, the employer withholds one 1,030 for income taxes, $800 for social security, $88 for union dues. Therefore, the net amount paid to employees is only $7,792. The journal is wage and salaries expense in the debit is 10,000, withholding tax payable, social security tax payable, union dues payable, cash in a credit. Next slide. Besides amount with help from employees, the company also incurs its own payroll tax by obligation. In this example, the employer must also pay its share of social security tax, which is also 8% of wages or $800 in this case. The journal is payroll tax expense in the debit sebesar $800 and the social security tax payable in the credit is $800. This shows that total payroll costs for the company go beyond just what is paid to employers. Employer tax are a significant additional expense. Next slide. And the last category is in employee related liabilities is we will cover compensated absence, which refers to paid leave for vacations, illness, maternity or paternity leave, and even jury duty. There are three classifications. First right, the employee has the right to be paid even after leaving the company. This must always be recorded as liabilities. The second one is accumulated rights. This can be carried forward to future periods if not used. They are also recognized as liabilities if payment is probable. And the third is non-accumulating rights. These expire if unused and are generally not recognized as liabilities since no obligation remains. Properly classifying this helps ensure the company accounts for the workforce relate obligation clearly and accurately. Next slide.
Okay, next slide. For the illustration, Amutran and Fee began operation on 1st January 2019. The company employs 10 individuals and pays its €480 per week. Employees earn 20 unused vacation weeks in 2019. In 2020, the employees used the vacation weeks, but now they each earn €540 per week. Amutran accrues the accumulated vacation pay on December 31 to 2019 as follows. Jadi sebelum itu di sini itu membahas tentang kewajiban perusahaan untuk mengakui dan mencatat pembayaran gaji serta cuti karyawan yang belum dipakai. Nah, cuti tahunan yang diakumulasikan dalam laporan keuangan. Jadi pada intinya perusahaan harus mencatat beban gaji dan kewajiban hutang untuk cuti yang sudah menjadi hak karyawan tetapi belum digunakan pada akhir periode akuntansi. Untuk pencatatan akuntansinya di sini untuk tanggal 31 Desember yaitu salaries and wages expense sebesar 9,600 dan di kreditnya ada salaries and wages payable sebesar 9.600. Kemudian di tahun 2020 it records the payment of vacation pay as follows. Salaries and wages payable in 9,600 and salaries and wages expense 1,200. And for the cash is 10,800 100. Oh. Okay, next is profit sharing and bonus plan. So payment to certain or all employees in addition to the regular salaries or wages. Jadi ini adalah rencana dan bonus pembagian keuntungan, di mana bonus adalah pembayaran tambahan kepada karyawan selain gaji reguler mereka. Kemudian juga bonus yang dibayarkan itu dicatat sebagai beban operasional. Dan bonus yang belum dibayar harus dilaporkan sebagai kewajiban lancar atau hutang jangka pendek. Okay. Next is a provision is a liability of uncertain timing or amount, reported either as current or non-current liability. Common types are obligation related to litigation, warranties or product warranties, business restructurings, dan environmental damage. Jadi provisi adalah kewajiban dengan waktu atau jumlah yang tidak pasti. Nah, ini dapat dilaporkan sebagai kewajiban lancar atau tidak lancar. Kemudian ada pula jenis-jenisnya yang sudah seperti saya jelaskan tadi, yaitu kewajiban terkait tuntutan hukum, kemudian garansi atau jaminan produk, restrukturisasi bisnis, dan juga kerusakan lingkungan. Okay, next is companies accrue an expense and related liability for a provision only if the following three conditions are met. Jadi, yang pertama ada company has a present obligation as a result of a past event, and then probable that an outflow of resources will be required to settle the obligation, and a reliable estimate can be made. Jadi perusahaan itu hanya boleh mencatat beban dan kewajiban untuk provisi jika 3 syarat ini tuh terpenuhi. Yang pertama ada perusahaan memiliki kewajiban saat ini akibat peristiwa di masa lalu, dan kemudian kemungkinan besar akan terjadi arus kas sumber daya untuk menyelesaikan kewajiban tersebut, dan juga jumlah kewajiban dapat diestimasikan dengan andal. Nah, untuk selanjutnya di sini ada recognition example. Okay, wait. Jadi ini warranty. Sitorus is give warranties to its customers related to the sale of its electrical products. The warranties are for 3 years from the date of sale. Based on past experience, it is probable that there will be some claims under the warranties. So the question is, should centers recognize at the statement of financial position that a provision for the warranty cost yet to be settled? Jadi okay, so for the answer is yes, Santos should recognize a provision for the estimated warranty cost because there is an exceeding obligation, and then probable outflow of resources and reliable estimate can be made. Jadi seperti yang dijelaskan tadi, Santos memang should recognize a provision karena dia memenuhi 3 syarat yang sebelumnya tadi saya jelaskan. Okay, next is constructive obligation, and is an obligation that derives from a company's action where by an established pattern of past practice, published or a sufficiently specific current statement, the company has indicated to other parties that it will accept certain responsibilities, and as a result, the company has created a valid expectation on the part of those other parties that it will discharge those responsibilities. Okay, for the next is another example. Jadi, Christian Dior has a policy of refunding purchases to dissatisfied customers, even though it is under no legal obligation to do so. Its policy of making refunds is generally known. For the question is, should Christian Dior record a provision for these refunds? Jadi, jawabannya adalah yes, because the refund policy is well known. Customers expect to get refunds if the amount of refunds can be reliably estimated. So Dior should record a provision for refunds. Next is lawsuit. Lawsuit. Okay, assume that an employee filled oh my god, 1 juta euro on November 30 tahun 2019 against WM Mauritian Supermarkets for the meat suffered when the employee slipped and suffered a serious injury at one of the company's facilities. Mauritian lawyers believe that Morrison will not lose the lawsuit, putting the probability of future payment at less than 50%. So, should Morrison recognize a provision for legal claims at December 31? So, the answer is no. A provision is not needed because the chance of losing is very low, yaitu less than 50%. A provision is only recorded if it is probable the company will have to pay an amount can be reliably estimated. Okay, so that's all for me.
Okay, that's it from our group. We only present until page 47. The next page of 48 and the next will be present by group 4. Thank you all for your attention.